Hello, and welcome to the VectorVest special presentation for the week of Friday, 11/17/2017. My name is Glenn Tompkins. I'm a Senior Product Support Representative and Instructor here at VectorVest, and it's truly my pleasure to give your presentation this week. This week's presentation is entitled 10 Tactics for a Strategic Defense of Your Portfolio. One of the biggest questions I get asked is, how do I know when to get out of trades once I've made some money? Well, these are tactics that are designed to be defensive in your portfolio, to lock in possible gains, and also to mitigate losses so that you can live to fight another day. Now, as I was coming up with this strategy, I was taken back to the time when we had the Strategic Defense Initiative under the Ronald Reagan administration. This was done by the Department of Defense, and this was a defense system designed to knock out ballistics from our enemies in case they came flying into our country. Well, the same kind of scenario. Your portfolio is what you're using to make money in the market, and you need to be able to protect it against anything adversarial within the market that could affect you in a bad way. So, as we look at this, let's define the Strategic Defense Initiative, the SDI. Initiative, an act or a strategy intended to resolve a difficulty or improve a situation, and that came straight out of the Oxford Dictionary. Synonyms for this are plan, sort of like a trading plan, knowing when to buy, what to buy, and this defense initiative is going to help you with your when to sell. Other synonyms are scheme, strategy, and stratagem. As I move on, you have to understand, why is this important right now? Why am I looking at being defensive in my portfolio right now? Well, I've got a couple of bullet points here. The MTI, the buy-to-sell ratio, and the RT are all coming off of recent highs that occurred on 10/5 of 2017. What else? The market hit an all-time high on 11/1 of 2017. And thirdly, we just recently received a confirmed down call on 11/14 of 2017. Let's get into the software. Let's take a look. As you can see, the market is down for the day with the exception of the VectorVest composite, which is slightly higher. We see we have two green lights, but still in a confirmed down call. Let's go over to the graphs tab, and we're going to go from a stock graph to a market timing graph. This is the market over the last year, and we can definitely see that the market is moving up. But what's the market doing right now? Let's take a look. Remember, the MTI, the buy-to-sell ratio, and RT all hit a high on about 10/5. Let me go find 10/5. Look at that. RT was at 1.07. The buy-to-sell ratio was at 3.65. And the MTI was at that all level of 1.50. It finished actually at 1.49. When the MTI gets to a level of about 1.5, though, the market is there looking for a top. Keywords, looking for. But ever since that day, what have these indicators done? They have gone down, and they've precipitously continued to go down since those highs. What else? On 11/1 of 2017, the market hit an all-time high with our VectorVest composite. We were not able to take out that previous high, so since that high, the market is lower than that high, so we're altogether trending a little lower. But we had 2 days right now where the market is trending higher, but until we can take out that high, the market is still trending lower. Now, what else? We did get a confirmed down call. Let's put on the confirmed calls. We got a confirmed down call on 11/14, followed by another nice down day. But since then, we've rebounded a couple of days, but still keeping in mind, we have not taken out the previous high. So from this uptrend to still say that it has legs, that won't happen until we can take out that high. So that's why we're looking to be defensive now in our portfolios. Let's get back to the slides. Now, let's move forward. The first three tactics, and remember, this is the Strategic Defense Initiative, and these are our tactics. The first three tactics are very simple. What happens if you look at a stock's price falling below the 40-day simple moving average? That could be defensive. Maybe you think about getting out of the stock. What if you miss that? Well, what happens if RT falls below the value of 1? The stock is now considered to be in a downtrend. That could be an opportunity to get out of the trade as well. Well, what happens if I didn't take advantage of these first two? This is your line in the sand. When the stock gets to be a sell recommendation, folks, that is probably the greatest opportunity to limit the bleeding and get out of the stock at that point in time. So let's take a look at this. We're going to go into our slides. Here's Lowe's, all right? We would have bought Lowe's on a confirmed up call that occurred on 7/11 of 2016. Boom. Did we have an opportunity to make money? The stock actually pulled back a little bit from the price that we would have gotten in. That's all right. Now, here is where the price of the stock falls below this white line, which is signifying a 40-day moving average. Folks, would that have been a great opportunity to pull the trigger on that trade and get out of it and limit or mitigate your losses? I'm going to suffice to say, yes, that would have been a great opportunity. What else was happening? Well, it falls below the 40-day moving average. RT was falling as the stock's price was moving slightly down. RT was telling you the stock was losing momentum and losing oomph. Not only that, the same day that the stock's price fell below the 40-day moving average, RT also falls below the value of 1. There are two alerts for you right there to say it's probably a good opportunity to pull that trade off of the table and limit your losses. The price fell below the 40-day moving average. RT is now below the value of 1. All right, let's say you didn't get out on either one of those. Next, the stock receives the sell recommendation on 9/9 of 2016. So if I didn't get out here and I'm holding it until it gets a sell recommendation, I am still losing money on the stock. That's why this lets you know, an alert. Be defensive. Think about taking the trade off of the table. If you ignore the sell recommendation, folks, you are doing it at your own risk. So those are the first three tactics. Let's go into the next two tactics. Never give back more than half your profits. You'll hear Dr. DeLito say that time and time again. But first, start off with number 5. You have to have a profit objective already in mind. Let's say I want to make at least 10%. Well, from that 10%, I can now say, if I get to that level, never give back more than half your profits, I should be just fine. Let me show this to you graphically. Still looking at Lowe's. Here's another confirmed up call. We would have gotten in there, purchased Lowe's on 11/15 at the price of $69.05. We set a profit target of 10%, which would have given us a price of $75.95. And it closed above that price on this date and then pulled back a little bit. But prior to looking at this information, you could have said to yourself, man, this stock is on a run. I'm going to give it a little bit more room. And maybe I didn't get out of that price objective. Well, if that's the case, now I'm going to say I should be getting out at least a 5% gain because I don't want to lose more than half of what I've made. My new stop or line in the sand becomes $72.50. Now I got to my profit objective. I can either get out and move to the next stock, or if I want to give this a little bit more room, I'm locking in at least 5% so I'm not losing more than half of what I've made. Tactic number 6. If a stock price crosses below a trend line, that's a great opportunity to pull the trigger. Here, we're still looking at Lowe's, drawing a trend line from a low, connecting all the higher lows. When the stock's price crosses below that trend line, that's a great opportunity to get out. How about this would have gotten me out prior to that $72.50, where I'm not losing more than half of what I've made. This, as long as the stock's price is moving higher, that's a great opportunity to trade it. Once the stock breaks down and breaches that trend line, that's a great opportunity to get out. All right, 6 simple tactics thus far. Now, the next 3 tactics are ideally suited for those people who are trying to hold stocks for the long term. These are your retirement stocks, and you're in them because they are moving up and they pay a nice dividend, and you really don't want to get out of these stocks. Well, options come into play. You can generate income by selling a covered call. You can buy protection by buying a put option, and you can take these two together and combine it into a trade called a collar. Now, that's a great way to protect not only an individual stock, but to trade or protect a whole basket of stocks. Let's take a look. We're still looking at Lowe's. Here, we bought Lowe's at the confirmed up call. How about the stock got to be a hold? How about that's a good alert to tell you something to say, ooh, I got to be defensive on that. When that happens, let's talk about setting up a covered call. Low receives a hold rating at $80.15 on 7/21. This is where you sell one contract 1 month out at $81.50. As long as the stock's price stays below the call you sold, you're going to take in a premium and maintain that premium all the way through. The cost basis on lows by taking in that premium is reduced now to $78.90. So going forward, or another way of putting on another options trade, earnings is announced before the open on 8/17. Folks, if you're trading stocks long term, you always need to know where earnings is going to happen, because you don't know what's going to happen with earnings. You could think that it's going to be good and the stock's price is going to go up, but they can surprise you and report lower. And if that happens, that could be a catastrophic move on the stock. So now, in this case, we talked about maybe selling the covered call, and as long as the stock's price stays below the call you sold, you're generating the income or helping to offset the price depreciation. In this case, we're preparing against earnings report. What do? Now I set up a put option. With lows trading at around $80, $81 in the midweek leading up to earnings, you buy 1 month out, the September lows, put at $170. That is money out of my pocket, all right, as insurance. As long as the stock's price goes down, as it did here, your put option goes up in value. And I'm going to tell you that at expiration, this put value went from $170, what I paid, all the way up until $9, which was an expiration right here. That was a great way to stay in the stock if you're trying to hold it for the long term and buy protection against what could happen with earnings. Now, another trade. Remember, here's our confirmed up call. We would have bought, in this case, Edward Life Science the day after the confirmed up call. So now we're moving from lows to Edward Life Science. Purchase 100 shares of Edward Life Science at $104 and 7/12. You would have held that stock all the way up into the confirmed down call. Folks, you had an excellent opportunity to make money until the confirmed down call. What happens on the confirmed down call? You now need to know that on that confirmed down call, we're up 12.67% or $1,321. That is an unrealized gain. Now you need to protect it, right? As soon as you get the confirmed down call, an alert. It's time to act. You need to be able to protect your assets. So now we're going to think about placing a collar trade. This is where we see the stock coming into the confirmed down call. RT was starting to go. That letting you know that the stock was losing momentum. That was the precursor to this big drop down in the stock price. How about RT is a very smart indicator. So what do? In this case, the day after the confirmed down call, we're going to think about selling a covered call. At the stock's prices at $118.39, we're going to probably sell a call at about $120. We're going to take in a premium of $3.80. That is for selling the call. Now, as we sold the call, we're going to buy a put to the downside as the stock's price is falling. We're going to be in the money by buying the put at about $120. So the stock's price is at $118. We're buying the in the money put. As the stock's price goes down, that put is going to make money, but it's also offset by the premium we took in for selling the call. So for buying the put, we spend out of pocket $3.20. Oh, but for selling the call, we receive $3.80, which now gives us a credit of $60 per share. Now, as we continue to go on, remember, folks, we bought the stock at $104. The stock's price, even when it fell, setting up this collar, got up to $115. We're still good on the trade, but we're protecting ourselves against this pullback after we receive the confirmed down call. Now, if we did not put the collar on and we did nothing, we're out $1,210. The price went from $104.95 down to $92.85. As we put this collar trade on, gain $1,061. That is why you look at putting these option trades on at the right time. Now, last but not least, the 10th tactic means or tells you to simply sell the stock. So if any of these tactics hit, boom, you're out of the stock, you've made your money or mitigated your losses, and that's important. Now, I'm going to show you all of the tactics here so that you can see them all. Price below the 40-day moving average, RT falls below 1, recommendation equals to sell, folks. If you wait until it gets to a sell, at least that's something, but that's your line in the sand. Never give back more than half your profits. Have a profit objective. I love this user trend line. As long as the stock's price is moving, whether it's up or down, and you're bullish or bearish, that trend line proves to be a great indicator of when to get out of a stock. And again, these three are primarily for your longer term holdings. Selling a covered call generates income. Buying a put is your insurance. Put them both together, you have a protective measure known as a collar. And again, simply sell the stock. Now, I'm going to go back into the software and let's talk about something or a stock that you may all be in right now, CTSH. Over the last year, look at that stock price. Beautiful equity curve. I'm going to use these tactics from the last confirmed up call, and let's see how we could protect ourselves. Last confirmed up call, look at that. Price moving higher from now up into the confirmed down call. I'm up, I'm making money. First one, price below the 40-day simple moving average. Notice that the stock's price did an excellent job of bouncing off. Intraday here, it did fall below, but it did close above, so we would not have gotten out there. Now, we've got a confirmed down call again on 11/14 of 2017. Today's activity, the stock's price is poised to close below the 40-day moving average. Now, is RT below the value of 1? No. But at least this is something that's telling me something needs to happen. I need to be a little defensive. So what am I looking at? How about not losing more than half of the money I've made? Keep that in mind. From here to here, I've made some money. Don't give back more than half of what you've made. If I have a profit objective in mind, maybe I hit my profit objective and now I'm managing the stock, or I got out at my profit objective. But nonetheless, don't lose more than half of what you've made on the trade. How about if the stock crosses below a trend line? Well, let's look at this low. And I'm going to draw connecting all these lows right here. How about this big day where the stock fell? It crossed below the trend line. Could I have gotten out of the trade right then? I could have, or I could have put some of those covered calls or buying puts in place. That tells me something needs to be done. Remember, I'm trading the trend line. The stock's price is doing a great job. Now I cross below the trend line. What could I do? How about considering selling a call? Right now on this date, let's take that off. On this date, the stock's price is trading at what? Close price $73.50. How about I buy a protective put at $75? And as long as it stays below that $75, like it is right now, that put is making money. That's a great way. How about I sell a covered call? Well, let's look at my most recent high on the stock at about $76.51. If I sold a covered call, give myself a little bit of cushion, I could probably sell a $77.50 covered call. As long as it stays below that $77.50, I sold that, I got a premium, I maintain that premium. How about now I put them both together and I provide a collar? I sell the $77.50 call and buy the $75 put. Man, I'm protecting myself. I'm making sure that I'm not losing money all the way. I am losing money by capital depreciation, but I'm making money hopefully on the option trade, still keeping me in this nicely uptrending stock as the stock starts to fall. So those option trades can serve as generating income, selling a covered call, or protection or insurance by buying the put them both together. I have a collar. All right, with that, folks, I'd like to say thank you for joining me for this week's presentation. Remember, this is the Strategic Defensive Initiative. This is a great way to protect your portfolio, and it gives you an idea, no matter if you want to get out of the stock right away or still hold the stock and use options. Folks, options is a great way to go. And for those of you who don't know about options, we do have pretty much a straightforward, simple options course. And for those of you who are well versed in options, we do have something called the Options Paycheck course. If you're interested in either one of those, please give our product support staff a call. They will be more than happy to assist you. But I hope that you walk away now with a sense of you can defend your portfolio at the times when you need to. Looking at the market timing graph, knowing what's going on in the market, knowing what's going on with our indicators is a great way to alert you it's time to be defensive on your portfolio. This gives you an opportunity to lock in profits on the stocks that you have and also mitigate the losses on stocks that you may have as well. It allows you to live to fight another day. So with that, folks, I'm going to sign off. Thank you very much. Have a great weekend, and I appreciate you listening this evening.